Monday evening, January 19th, 2026. Nothing looks wrong yet. The markets are quiet, sports are on, social feeds are scrolling, and beneath that calm surface, something critical is grinding to a halt. I need to tell you something most people won't understand until it's already too late. For over a decade, I've tracked physical silver markets. Not the paper price you see on a screen, but the real metal that has to be mined, refined, shipped, insured, stored, and delivered. And right now, the global system that moves silver from where it exists to where it's needed is running straight into a concrete wall. On Friday afternoon, the financial media focused on a story they framed as diplomacy, Greenland, real estate, negotiation tactics, trade leverage. That's the narrative being sold. But narratives are not reality. This is not about land. It's not about Arctic resources or geopolitical posturing. What happened on Friday night set off something far more dangerous, a physical liquidity trap that threatens the very mechanism used to price silver globally. The London Bullion Market Association, LBMA, is at the center of that mechanism, and it is being slowly suffocated. Here's what actually happened. Late Friday, after London had already shut down for the weekend, the administration dropped what I can only describe as a tariff shockwave. A 10% tariff on imports from 8 European Union nations, plus the United Kingdom, effective February 1st, 14 days from now. And buried inside that announcement is the detail that should make every serious silver trader stop breathing for a moment. The United Kingdom is on that list. London is on that list. The single most important physical silver hub on Earth outside New York is now facing a tariff barrier between itself and the only remaining deep pool of available metal. By the time futures markets reopen, the old assumption that silver can always be moved freely between New York and London will no longer be valid. And this isn't speculation. It's arithmetic. Tariffs don't just raise prices, they change behavior. A 10% tariff may not sound catastrophic at first glance. Markets absorb friction all the time. But in physical commodities, especially one as thin and leveraged as silver, friction changes everything. What this tariff does is create a one-way valve. Silver can leave the United States, but it becomes economically irrational to bring it back. And that single constraint breaks the global balancing mechanism that has kept silver prices aligned across continents for decades. Here's why this matters. The London silver market runs structurally short. It always has. It relies on borrowing metal from other exchanges, primarily New York, to meet delivery obligations. That borrowing is invisible to most investors because it happens through leasing, swaps, and opaque interbank agreements. But remove the ability to cheaply move metal across the Atlantic and the illusion collapses. Under the new tariff structure, every ounce of silver that leaves a U.S. vault becomes permanently more expensive to replace. At 10%, it's painful. At 25%, it's prohibitive. This transforms silver into a trapped asset. U.S. vaults become hoard zones. London becomes a starvation zone. And the pricing system, built on the assumption that metal can flow freely, starts lying. To understand why this is so dangerous, you need to understand arbitrage, not the buzzword, but the plumbing. Arbitrage is what keeps prices honest. If silver trades higher in London than New York, traders buy in New York, ship to London, sell the difference, and pocket the spread. That flow equalizes prices. But arbitrage only works when transport costs are lower than price differences. Tariffs destroy that balance. With a 10% tariff, silver must trade at least 10% higher in London just to justify movement. At 25%, London needs to pay an extraordinary premium simply to pull metal across the Atlantic. That's not a market inefficiency. That's paralysis. When arbitrage dies, price discovery dies with it. And that's when you get two silver prices, a trapped U.S. price, a starving London price. History shows what happens next. Shortages, delivery failures, rule changes, or force majeure. None of them are benign. Let's strip this down to numbers. Silver sits around $90 per ounce. At 10%, importing silver into the U.S. adds $9 per ounce. At 25%, that cost jumps to $22.50. Now here's the critical insight. For silver to flow out of the U.S. and back again without loss, global prices must rise enough to absorb that friction. That places the minimum functional arbitrage price above $112 per ounce. This is not a forecast. This is not a prediction. This is the math required for the system to function. If prices remain below that level, metal does not move. Period. And when metal doesn't move, contracts break. Now look at what's happening in U.S. vaults. Registered silver, the metal available for delivery, isn't leaving. Not because demand disappeared, because replacement costs are now lethal. Every ounce that exits becomes a liability. Smart money understands this. They are not selling. They are not shipping. They are waiting. And London doesn't even know it's trapped yet. London's vulnerability is not accidental. It's structural. The LBMA does not operate like a traditional exchange with transparent inventory and firm delivery guarantees. It operates as a clearing nexus built on trust, leasing, and rehypothecation. The same ounce of silver can be pledged multiple times across different contracts, as long as nobody asks for it all at once. This works beautifully in calm markets. It fails catastrophically when physical movement is restricted. London relies on continuous inflows to meet delivery needs. Unlike New York, it does not maintain deep surplus buffers. It assumes access. It assumes mobility. It assumes arbitrage will always function. The tariff destroys those assumptions. Once U.S. metal becomes economically sticky, London is forced to rely on its own dwindling stockpiles. There is no emergency reserve waiting in Zurich or Singapore large enough to cover sustained delivery stress. The system was never designed for that. This is why London always breaks first. Not because of demand spikes, but because its leverage is geographic. The irony here is brutal. In early 2025, bullion banks believed they were being proactive. The Section 232 review, used to assess national security risks tied to imports, was coming. Silver's role in solar, defense, and electronics made inclusion inevitable, so they front-ran the risk. Metal moved out of London and into U.S. COMEX vaults at historic scale, tens of millions of ounces relocated in a single quarter. The logic was simple: protect supply before restrictions hit. But the banks made a fatal assumption. They assumed restrictions would apply only to imports. What they failed to model was export friction. The tariff didn't trap silver out of the U.S. It trapped silver inside the U.S. That single oversight flipped the entire risk profile. What they believed was defensive positioning became a self-constructed prison. They didn't hedge logistics. They hedged headlines. When pressure builds in metals markets, the first response is always paper. More contracts, more derivatives, more synthetic supply. It has worked before, but paper cannot move atoms. No amount of futures selling can teleport silver across an ocean when tariffs turn transport into a loss-making exercise. Derivatives can suppress price signals temporarily, but they cannot fulfill delivery obligations when physical metal is unavailable. This is the core mistake most analysts make. They treat silver like a financial asset. It is not. It is an industrial input with mass, volume, and shipping constraints. When those constraints tighten, price becomes secondary to availability. Paper delays panic. It does not eliminate it. Once arbitrage fails, markets fragment. This is not theoretical. We've seen it before in energy, shipping, and food commodities. Silver is next. A U.S. price anchored by trapped inventory, a London price inflated by scarcity. At first, the spread will be explained away. Analysts will call it a temporary dislocation. Media will cite regional logistics challenges. But spreads don't close without flow, and flow is now taxed. When physical buyers in London pay materially more than New York and still can't source metal, the fiction collapses. Two prices mean one thing: the benchmark is broken. Retail investors react to price, industrial buyers react to risk. A solar manufacturer cannot wait for silver to pull back. A defense contractor cannot delay production because futures dipped 2%. When industrial users sense supply uncertainty, they do one thing: secure inventory at any cost. This demand is not speculative. It is compulsory. And once it enters the market, it overwhelms paper suppression. This is the phase that turns stress into crisis. Not because investors panic, but because factories cannot shut down. Mainstream financial media is structurally incapable of catching this early. They follow price, not plumbing. They respond to volatility, not inventory stress. And by the time price moves violently enough to justify airtime, the underlying damage has already been done. Silver's problem is invisible to headline culture. A tariff doesn't flash red on a chart. A broken arbitrage mechanism doesn't trend on social media. Inventory friction doesn't fit into a 5-minute segment between earnings reports and political commentary. So coverage will lag reality. When prices finally jump, the explanation will be backward-looking. Analysts will cite unexpected demand, speculative frenzy, or sentiment shifts. None of that will be true. The cause will have been logistical all along. By the time the story is told correctly, positioning opportunities will be gone. When physical stress becomes impossible to ignore, exchanges face an ugly choice: deliver metal they don't have, or change the rules. Cash settlement is the pressure release valve. It allows an exchange to meet contractual obligations without delivering physical silver. On paper, it solves the immediate problem. In reality, it detonates confidence. The moment market participants realize that a silver contract does not guarantee silver, the nature of the asset changes. It becomes a fiat proxy, not a metal claim. That realization triggers a behavioral shift. Holders who thought they owned metal scramble to acquire the real thing. ETFs bleed trust. Vault programs face scrutiny. Premiums explode. Cash settlement doesn't end a crisis. It accelerates it. Comparisons to 2011 are misleading. That rally was demand-driven. Investment money surged into silver, chasing inflation fears and momentum. Banks responded by increasing paper supply, leasing metal, and moving inventory. They had flexibility. This situation is different. Demand is not the catalyst. Constraint is. The banks are not facing too much buying. They're facing too little mobility. The old suppression tools assume physical access. That assumption no longer holds. This is not a squeeze driven by enthusiasm. It's a breakdown driven by logistics, and logistics do not negotiate. Everything on paper hinges on Greenland. Make a deal, tariffs soften, fail, tariffs escalate. Markets are currently pricing in resolution. That may be a mistake. Greenland is not just an asset, it's sovereignty, culture, and geopolitics layered together. Denmark cannot move quickly without internal backlash. Greenlandic leaders cannot concede without political fallout. The European Union views the issue strategically, not transactionally. Time is not aligned. The tariff clock moves faster than diplomacy, and markets consistently underestimate political inertia. Every day without progress increases the probability that February 1st arrives unchanged. There will be a moment, quiet, technical, easily overlooked, when arbitrage truly dies. It won't be announced. It will show up in spreads that don't close, in delivery delays explained away as processing issues, in premiums that rise without price confirmation. That's when the market shifts regimes, from financial to physical, from price discovery to availability discovery. Once that line is crossed, the system cannot revert without policy reversal or price shock. And history shows it usually chooses price. When exchanges sense instability they cannot control, they reach for one tool first: margin. Margin hikes are not neutral risk management. They are behavioral levers. By raising the capital required to hold positions, exchanges force weaker hands out of the market, often at the worst possible moment. In silver, this tactic has a long history. A sudden 20-30% increase in margin requirements doesn't target physical holders. It targets leveraged traders, hedge funds, and speculators operating in the paper market. The result is predictable: forced selling, temporary price dips, and a false impression that pressure has been relieved. But margin does not create supply. It simply reshuffles paper claims. If physical constraints remain, and in this case they do, margin hikes become a delaying tactic, not a solution. They buy time for institutions to reposition while obscuring the real problem. That's why margin hikes, paradoxically, are a warning sign. They signal that internal stress has crossed a threshold. One metric cuts through noise better than any headline: the exchange for physical spread. EFP exists to bridge futures contracts and real metal. Under normal conditions, the spread is minimal, cents per ounce, reflecting a healthy linkage between paper and physical markets. When that spread widens, something is wrong. A widening EFP spread means holders of futures are demanding real metal, and the system is struggling to deliver it at posted prices. It's the market whispering before it screams. At $1, it's stress. At $2, it's concern. At $5, it's rupture. Once EFP disconnects, paper prices become theater. Physical reality takes control. Every exchange has an escape hatch, force majeure. It's the clause reserved for events beyond reasonable control: natural disasters, wars, systemic failures. It allows obligations to be suspended when delivery becomes impossible. Invoking it is not a technical event, it's a reputational one. If force majeure is declared, the message is unmistakable. The system cannot do what it promised. Contracts, once assumed equivalent to metal, are revealed as conditional claims. Trust does not recover quickly from that. Markets remember. And when trust breaks, participants demand premiums or leave entirely. Contrary to popular belief, bullion banks are not afraid of high prices. They can hedge price. What they cannot hedge is immobility. The entire fractional system depends on the ability to move metal between locations as needed. That flexibility allows shortages in one region to be patched with surplus from another. Tariffs sever that flexibility. Once movement is constrained, the shell game fails. The same ounce can no longer satisfy multiple claims across borders. Accounting tricks meet physical limits. That is the fear. Not price volatility, but exposure. When this resolves, it will not resolve quietly. Either policy changes and restores flow, or prices rise until flow becomes economical again. There is no third option. If tariffs persist, silver must reprice to compensate for friction. That repricing will not be gradual. It will occur in steps driven by shortages, premiums, and forced adjustments. Those holding physical metal will not need to act. Those relying on paper promises may discover too late what they actually own. This is not a bet on sentiment. It is not a call based on hope. It is an observation grounded in mechanics. When logistics break, price follows. And when the valve finally shuts, the only thing that matters is what you already have, not what you thought you owned.